When people talk about real estate syndications, one of the first things that often comes up is a return. And more specifically, high projected returns. Now, you may see a pitch deck showing 20%, 22%, or even 25% annualized returns. You may hear someone say, oh, this deal is targeting 2x equity multiple, or this one has a very high IRR. And naturally, that gets attention. Because let's be honest, right? When someone presents a real estate opportunity that appears to project returns far higher than what people are used to seeing in public markets, it is hard not to be curious. But over time, I've started to believe that investors sometimes ask the wrong first question. The first question should not be what return this deal is projecting. The better question is what has to happen for this return to actually materialize. Now, that word question changes everything because high returns do not come out of thin air, they come out of assumptions. The sponsor is assuming something about rent growth, expense control, financing, future property value, refinancing conditions, cap rates, and execution timelines. And that is where things get interesting. A deal projecting very, very high return may not be bad, but it is usually asking reality to cooperate in a very specific way. It may need rents to increase quickly. It may need renovation timelines to move smoothly. It may need interest rates to behave. It may need a refinance to happen on the right time. It may need a future buyer to pay a certain price. So in a spreadsheet, all of this can look clean and logical. But real estate is not lived in a spreadsheet. Real estate is lived in leases, repairs, tenants, insurance renewals, property taxes, local economies, contractors, lenders, and unexpected surprises. And the last few years gave investors a very real reminder of that. Many syndication deals that were put together between 2019 and 2022 were built during a very different environment. Interest rates were low, debt was cheap, rent growth looked strong, refinancing seemed easier, and property values were rising. In that kind of environment, aggressive underwriting could look reasonable. Then the environment changed. Starting in 2022, interest rates rose quickly, borrowing costs went up, floating rate debt became more painful, refinancing became harder, cash flow got squeezed, cap rates expanded, which means property values could fall even if the building itself was still standing, still occupied, and still collecting rent. So that is one of the strange things about commercial real estate. The property may not look dramatically different from the outside, but the value can change significantly because of the financing environment changed. The deal that looked strong when the debt was cheap could suddenly feel fragile when debt became expensive. And that is exactly what happened to many, many deals. Some operators had to request more capital for investors just to support the property. Some deals continued operating but delivered returns far below projections. And in more severe cases, investors lost part of their capital or even all of it. If you personally know people who went through this, you're not alone. A lot of investors learn that a projected return is not the same as an actual return. And by the way, I know friends who have lost their money in syndication last few years as well. Okay, not in ours, but other syndications. So it is possible that people might conclude that, well, syndications are bad, right? But that's too simplistic. It would be like saying stocks are bad because some stocks lose money, or that real estate is bad because some landlords overpay their properties, right? The structure of syndication is not a problem. The real question is how the deal is underwritten, how much risk is being taken, what assumptions are being made, and whether the investor understands the role that syndication is supposed to play in their overall portfolio. Because syndications are not all the same. Some syndications are aggressive. They may use higher leverage heavily on future rent growth, rely on refinance, or assume very profitable sale in a very few years. Some syndications are more speculative. They may be buying a troubled asset in a hope that a major turnaround will create a big payoff. And then there are conservative syndications. Yes, they do exist. They just don't really lead with the flashier numbers. A conservative syndication is generally not trying to impress you with the highest return projection in the room. It is usually built around a different idea. Project, protect the downside first, and then allow the upside to happen from there. That may sound boring, but in investing, boring can be very underrated quality. A more conservative deal may use lower leverage, so the property is not overly depending on debt. It may use fixed rate financing, so the business plan is not constantly exposed to the interest rate shocks. It may assume modest rent growth instead of pretending that every tenant will accept a large rent increase every year. It may focus on income that already exists at the property rather than relying entirely on the future improvements. It may also keep stronger reserves. That part matters more than many people realize. Real estate always has surprises. Insurance may go up. Property taxes may come in higher than expected. A roof may need work earlier than planned. A few units may stay vacant longer than the model assumed. A contractor may open a wall and discover that the repair is more complicated than expected. None of these things are unusual. They are part of owning real estate. The question is whether a deal was built with enough room to absorb them. That is one of the biggest differences between an aggressive deal and a conservative one. An aggressive deal may work beautifully even if everything goes right. But if the business plan is too tight, even few surprises can cause real pressure. And you know where the aggressive deal really falls apart? Is in bad times. The economic uncertainty, high interest rate environment, right? Those are the cases when the aggressive deal will probably fall apart. But a conservative deal, on the other hand, may not look exciting on day one. The projected return might be lower, maybe 10 to 15%. Maybe it is instead of 20 to 25%. But the deal may be structured to survive in a less than perfect world. And real estate is always less than a perfect world. That is why investors need to step back and ask a deeper question. Why are you investing in syndications in the first place? If the only answer is because I want the highest possible return, then you may naturally be drawn to the more aggressive deals. But I don't think that's the best way to think about syndications. A syndication is not just a return vehicle, it can play a broader role in your financial life. The first thing syndications can offer is diversification. Many professionals already have a large portion of their wealth tied in the stock market. Their 401k, brokerage accounts, index funds, RSUs, and sometimes even their company stock are all connected to public equities. In some cases, their salary, career, and investment portfolio are all exposed to the same economy, the same industry, or even the same company. Now that creates concentration risk. Multifamily real estate gives exposure to something different. It ties to a physical property, it is tied to housing, it is tied to people needing a place to live. That does not mean it's risk-free, but it does mean it behaves differently from a portfolio made entirely of stocks. That difference has value. The second thing syndications can offer is tax efficiency. One of the reasons people like real estate is that tax code often treats real estate ownership differently from many other investments. In multifamily syndications, limited partners may receive tax benefits similar to direct ownership, including depreciation, and depending on the current tax laws and a specific deal, bonus depreciation. These benefits do not magically make a bad deal good, right? The tax rules always depend on your personal situation, so you should absolutely discuss with your CPA. But for many investors, the after-tax outcome is a meaningful part of their real estate story. Sometimes the headline return is not the whole return. What matters is what you actually keep after taxes. The third thing syndication can offer is passivity. Owning real estate directly can be rewarding, but anyone who has done it knows that the word passive does not really apply. At first, it looks simple to buy a property, rent it out, and collect income. But then real life begins. You have to find right property, negotiate the deal, arrange financing, understand the local rental market, deal with repairs, handle vacancies, review insurance, manage property taxes, and make decisions when something unexpected happens. And something unexpected always happens. A tenant leaves earlier than planned. A water heater fails. Insurance premium go up. A contractor gives you one estimate and then discovers two more problems after opening the wall. This is not a complaint. This is simply what ownership look like. Real estate can be a powerful wealth building tool, but direct ownership requires time, judgment, and emotional bandwidth. That is why syndications can be attractive. They allow you to participate in larger real estate deals without making property management your second job. You're still exposed to real estate. You still participate in economies. But you're not the person getting pulled into every operational decision. For a busy professional, that difference matters. And this is where conservative syndications start to make more sense. If your goal is diversification, tax efficiency, passive ownership, and a long-term wealth creation, then you may not need to deal with the highest projected return. You may need a deal that is thoughtfully structured, reasonably leveraged, managed by a capable operator, and built on assumptions that do not require everything to go perfectly. There is a very important difference between a deal that creates wealth and a deal that simply projects wealth. A projected return is easy to show in spreadsheet. You can change rent growth assumptions, exit rate, cap rates, financing, refinance timing, sale price, and suddenly the number looks beautiful. But the real test is whether business plan can survive reality. What happens if the rent grow more slowly than expected? What happens if insurance costs increase? What happens if interest rates stay higher for a longer period of time? What happens if the property cannot refinance on original timeline? Uh, these are not negative questions. These are just responsible questions. Yeah. And that is why there is a space for conservative deals. And if you want conservative deals, then you need to find a operator, a syndicator, a general partner that thinks that way. And old money capital is structured around that thinking. We don't project higher returns, and we try to place conservative deals that give you all these benefits, maybe not the highest return, right, to people. If you're interested in some of these deals, then please contact us on oldmoneycapital.com and click on request a call button. Our YouTube channel is Old Money Capital, and our Instagram handle is Old Money Capital 123. Thank you very much for listening. This is the OMC Real Estate Podcast.